OJ on, a little audio check. Someone in chat says stocks should be yellow. Fair point. Very fair point. My green is arguably a bit aggro right now, a bit biased. I usually try not to show my bias directionally, but there it is. Good afternoon. Welcome to Chicago Future Finance. I'm Oliver Renick. 2 p.m. here in Chi-Town, hour until the bell, and it's pretty quiet. I think that's a good thing. We got crude oil up 5.5%. Stocks are just shrugging it off. I'm going to call that a small W, considering that oil has essentially been the main catalyst. The fact that we've got a pretty good move here, and the stocks are cruising through it, I think is a good thing. Looking at the map right now of markets, and you do have some green. Obviously, you've got more red than green, but we are not off big by any means. And in fact, the semiconductors are up right now 80 basis points, and that is still my guiding light for markets. Someone in chat commented that stocks should be yellow on my risk radar. That's arguably correct. Maybe I'm a little aggressive with the green light, but I'm holding it for now, and the reason is because, well, I have a little bit of a bias. I just generally think that geopolitical events and crude oil are largely fadeable events. And that the trend, if you look at chips, is what's most important. Because remember, this is the group that really is the powerhouse, that's the most reliable. It combines tech, it combines growth, it combines value. It's the beneficiary of AI. It's not perhaps the loser in the AI trade, but here's what's interesting is actually the loser of the AI trade, which has been cloud stocks. They firmed up for 2 straight weeks and are doing literally nothing. in the last 2 days, which I think is a huge win. So in the evisceration of cloud over the last couple months and basically year to date, there's calm in that water. There is strength in semiconductors. There's a little strength in crypto too, which I still give some credibility as a risk asset, even though it underperformed stocks in an up year. It lost some of that notoriety, but I still think it's Bitcoin, it's crypto, it's risk generally. But that's also why I've got the yellow light on Bitcoin versus stocks, where equities generally have been the more reliable risk on trade. There's yellow across the board basically everywhere else. Bonds and the dollar, few charts there that are noteworthy given some of the action that has been notable but still largely range bound. Look at yields, for example, a pretty sizable swing here over the last couple months, which was from the upside in the range of 4.3% in the 10-year, then down below 3.9, then back up to 4.2. Keep in mind, we also did get inflation this morning in the form of CPI, which also is an important number that was calm. There it is, right in line with expectations, 0.3 on the month over month, 2.5 over the year over year, so there's no big surprises there. And the fact that bond yields are up, I don't think should be terribly concerning. The reason why is because the low for yields came right in the middle of this kind of geopolitical scare and also the AI scare too. So there were generally traditional reasons, risk-off reasons to sell or rather buy bonds. And so now we're selling bonds as the market firms up. So keep in mind the Treasury still just get that risk-off bid. Geopolitical unease, the big cloud sell-off, maybe people were buying bonds out of a traditional safe haven move. So yields letting up, bonds letting up and yields moving higher, I don't think is a bad thing for markets necessarily. So that's the roundabout overall for the risk radar. We are still very much treading water, but considering that volatility in the VIX is still elevated for options traders, which is what we focus on here on the show, 25 volatility VIX still seems like an opportunity to collect a premium or at least use some spreads if you want to pick a direction. And me personally, your humble host, I kind of like the direction of being upwards. We've got a great show coming up here. Michael Khouw is joining me from YieldMax. We've got Jon Najarian right behind him, and then Mike Loukas from TrueShares, and Scott Bauer taking us into the closing bell. So it is a packed afternoon here on Chicago Future Finance. I appreciate you tuning in. Let's get Mike into the mix here, joining us, Chief Strategist at YieldMax ETFs. Mike, great to have you on the show. You are a trading and options pro and legend, dare I say. Great to have you here.
Hey, thanks for having me.
You know, my bias, I keep looking at this market and I feel like it's more the calm before the rip rather than the quiet before the dip. But hey, this market has gone both ways and essentially to nowhere largely over the last several months. Give me your overall take, how you're reading this market, and especially with the context of VIX staying bid at 25, which of course is significantly above the average.
Yeah, if we didn't have what was going on right now in the Middle East, I'd be with you 100%. I definitely think that we were well positioned to begin the year off strong. I mean, most of the information we've gotten, I think, has been pretty good. Some of the inflation data, maybe a little bit hot. Some of the labor data, perhaps a little bit weak. But I would have to say that, you know, it's really what's keeping a lid on the market right here and now is essentially what's going on in the Middle East. And I think people are just waiting for a little bit of clarity. That's why we see such a bid to vol. And it makes some sense. Look, 50 basis points to 100 basis points of global GDP traverses the Strait of Hormuz every single day. So when there is a threat to that part of the world, it's going to matter for the global economy, and it's going to matter for risk assets, and it's going to matter for equities, and therefore you're going to see a bid to the VIX.
Volatility has been on this uptrend. It's pretty amazing. A lot of folks say, hey, do TA on the VIX at your own peril. I'm a little primitive sometimes, and I don't mind doing that, Mike. Drawing a line on VIX, and I mean, it's been working pretty well. This thing just doesn't want to go below 20, basically, and it's been uptrending for months. The question is, does that kind of gradual uptrend turn into something explosive from here, or is that what we got 3 days ago, and should we default and go, you know what, VIX 25, usually I want to collect premium there. I want to bet that it comes back down.
Well, that's what we do, of course. We try to capitalize on that, and we have been. Across our family of funds, we were seeing a big increase in the amount of premium we've been able to collect over the course of the last couple of weeks. And this is largely the reason. If you think about it, what is the circumstance when you're going to have exposure to underlying equities and outperform those equities? The circumstances when equities are sort of range bound or over the longer term sort of trading sideways, but options premiums increase. So that's kind of the sweet spot for those that are looking to sell some premium. So I understand why your instinct leads you that way. Right now, we have a good reason why stocks aren't going to take off, but that same degree of uncertainty has created a bid for the options on those underlying assets. And so there is an opportunity here, I think, in many quarters to sort of take advantage of that. And, the other thing is that we're catching a bid sort of across the equity complex. So what's going to cause the VIX to rise, really? It's two things. One is going to be the volatility of the S&P. What is the S&P's volatility? But basically the composite of the volatility of all the underlying stocks and also their respective correlations, right? So, when you get into an environment where you have a geopolitical thing at a really large macro level, people get concerned that you're going to have a risk-on, risk-off environment. So the implied correlation rises a little bit. It had been very much compressed because what's a popular trade for options, guys? Options traders love dispersion, right? So you buy single stock vol, you sell index vol, and if everybody's on one side of the boat, you're going to see the VIX come in, all else equal. And I think that, I think this is a healthy action, I have to say, what we've got right now in terms of the relationship between index and single stock volatility.
Looking at the correlation, just 1 month here, pulling it up, it obviously has gotten elevated. The dispersion trade was the trade basically for so long, and that's kind of broken because of this. A lot of times correlations go up to the downside, but they certainly can stay, bid to the upside as well. We haven't seen that in a while because it was such a skewed, big tech Mag 7 kind of concentrated market, Mike. I'm wondering how you'll be looking at dispersion and correlations as maybe a directional guide. Is there anything we can glean where we say, okay, since we sold off kind of handily altogether here in the last couple of weeks, do we bounce back that way? Or do you think more likely we go back to that kind of big tech-led, very specific, still high dispersion kind of market?
So, what's really interesting is that we think about tech as a monolith, but it isn't. And it hasn't been actually for some time. Let me provide some sort of concrete examples to that. If you go back from the end of December of 2024 and look at the first half of 2025, technology was a monolith. Everything sort of tracked up and down together within the space. From July 1st until the end of the year, we saw a big break. Hardware and software basically went in opposite directions. You had the Microns of the world that just blew the doors off, and you had Microsoft trade substantially lower, the biggest software company in the world. And that divergence actually accelerated this year. So if you can imagine that IGV, for example, which was the software industry ETF, underperformed XLK, the technology sector ETF broadly, from July until the end of last year by about 17.5%. Up until about 2 weeks ago, that divergence actually was 23%. So the move in a much shorter period of time was much sharper just since the beginning of this year. And this is a great chart you got right here, because one of the things that we saw...
IGV just getting smoked.
Yeah, it got. XLK. But take a look at how much relative performance it's had over the last 2 weeks. It actually caught a bid. I'm going to give credit to one of our traders over here. I'll even throw his name out because I don't want to take credit for it myself. But Corey Reed, he was actually bringing this to our attention back on February 13th, and he was just saying, is this going to represent, on a relative basis, potentially a historic buying opportunity in software and services relative to tech? And really what is driving this trade, it's been two things. The first thing that's been driving it is this concern that AI was going to eat software somehow, right? So there was that whole perception. But meanwhile, Microsoft's a big part of the AI trade, and that was the largest one, and that was a big underperformer. You take a look at the biggest hardware company, NVIDIA, compare it to the biggest software company, Microsoft, and there was a huge divergence. And I actually think that Microsoft got oversold in all of that. That's, my 2 cents, not a buying recommendation. I'm not in the securities selling business, but I think it's an important thing. So I actually believe that there's a chance that this spread that you have on your screen right now, I think it at least stabilizes. I don't expect it to get a whole lot worse. The other thing that propelled it is that I think software got sold off because a lot of people are aware that the private credit markets have exposure to software. But public equity software and private credit software are not the same thing, right? Even though, under the hood, I think that there was some mechanism of these two trading together.
It's a great point. And also to your point of how some of these correlations have shifted, I just pulled up Blackstone, which is basically making new lows as we speak. Apollo, same story, while the software has broken away from that. So I think that also hopefully speaks to your point too, which is that you're starting to see some delineation happen where there was a very kind of categorical, as they say, throwing baby out with bathwater. That's why they have that cliche for those moments when just everything goes that's in that same bath.
One other thing I think that people should pay attention to is that we just saw the announcement that Boaz Weinstein is taking a look at this space. I love to see opportunistic investors coming in and saying exactly what you're talking about, which is that there is a baby with the bathwater type of a thing. Now, if you look at some of these big outfits, whether it's like a BlackRock, Blackstone, or Apollo, they can see weakness or pressure as a result of calls to make withdrawals from some of their funds, but that doesn't mean that everything in there is junk. You can just it's a momentum shift, right? And when you start seeing opportunists come in, like Boaz coming in saying, okay, well, maybe there's something to be done here, that suggests that some of that stuff might be getting oversold. Doesn't mean that there's not more shoes to drop. There probably is. There always is in the credit world, right? It never begins and ends in a week. So we're not expecting that. But it is good to see opportunists who really are value investors coming in and saying, well, maybe there's some things that we can start picking up at a discount.
I love that point, and I think it also helps to give us some degree of maybe confidence in the overall situation that we're taking this piecemeal. There have been cuts made. We saw layoffs happen. We saw pretty big moves, in the software space. But the fact that we have this kind of larger macro uncertainty and those stocks now firmed up, I think it's a really important point. I want to come back, Mike, as we kind of think about action and the immediate stuff, which is, to your point, areas where volatility opportunities are more pronounced than others. I think it's a good time to look at YieldMax XOMO. This is a pretty interesting one that is Exxon focused but still uses options. Take me through this, because this gets pretty fun. You can go with the same kind of income strategies that have become really popular, but you can focus it in on a particular name, obviously, that's smack in the middle of the conversation right now.
Yeah, well, I mean, what we're dealing with here is, one of the largest, if not the largest, integrated oil companies in the world. And look, if you own Exxon, you're going to be collecting a dividend, but a lot of people are looking for distributions in their investments that are substantially higher. And a lot of people are looking to collect a little bit of a volatility risk premium as well. I don't think I need to tell anybody that volatility in oil and in oil companies has increased significantly recently. So you have net long exposure, you have big distributions, and of course you're capitalizing on that much higher volatility. And, the thing about an integrated oil company that I think people should remember, and what is an integrated oil company? It basically is upstream, midstream, downstream. They have the whole exposure to the complex. But the way these things typically trade is basically as a basket of reserves of oil, right? So, if you're interested in the oil complex, and it's hard not to be right now, and their exposure is not exclusively going to be based in the Middle East, then this is one of the places that you could look. In fact, I would actually say that a lot of the integrated oil companies, their exposure isn't exclusively limited to that portion of the world. They sell a commodity that is global, and yet they don't necessarily have all of the exposure to the region that's causing such volatility in the underlying asset. So that makes them very well positioned in an environment like this.
The other thing too is, for a lot of people, if they've got energy in the portfolio, or they want to have exposure to this because of what's going on, but then they want to have options as a way to kind of hedge that position. I mean, this is pretty much, you're paying 99 bips for the machine to do it for you, to have that option income on top of it. Exxon is kind of we think about energy companies as a dividend payer too. How does that factor into it? Is this like a particularly juicy way to get income then?
It is. I mean, well, you know this as an options guy. One of the things is that there are no real arbitrages in the market. So if you buy the stock and you sell upside premium against it in the form of calls or call spreads, we typically use call spreads to collect premium. And the reason we do that is so that if you get an exogenous shock type of a factor and all of a sudden something rockets higher, we want to make sure we get some participation. So we're going to mitigate some of the options premium that we collect a little bit in exchange for better participation to the upside. So we want to make sure we're getting, we'll call it about 80% in those really big up move situations. So if you run a strategy where you're long the underlying, or if you, say, have a proxy position via synthetic. What's a synthetic? That's, I buy a call and sell a put of the same strike and expiration. Synthetically, I'm essentially getting into a forward for the underlying. The options markets are efficient. They're going to price in any relevant dividends. So if there is a big dividend between now and options expiration, the puts will be worth more, the calls will be worth less. So you're essentially going to get paid for that as well. Whether you're using the synthetic or you're actually using the stock, you're not really sacrificing it one way or the other. But when you do a volatility risk premium capture strategy like this, yes, the goal is to enhance the amount of distributions you get while still maintaining some exposure to the underlying asset. In our case, we're targeting 70, 80%.
I think also the timing too, Exxon's had a big move. The timing of doing this type of approach kind of after it's had a big move arguably makes some more sense too. You can play the trend, but you also then kind of realize that, okay, when you've had that type of volatility, there's going to be a little extra juice you can get from that premium, I think.
That's actually a great point. I don't know if you know Carter Worth. Carter Worth, sometimes
Sure.
referred to as the chart master. This is a point he makes all the time, that when you get these big moves, the market can be most efficient at repricing an asset after something takes place. So whether it's earnings for a stock, so you'll see a stock trading along, then it gaps on earnings, and then what happens? It finds a new level and trades within a range on that new level. You get new information. The market's oftentimes very efficient at pricing that in. And of course, in an oil business case, this is going to be especially true. Why? Because we know what they sell. And we know how much of it they sell, and we know how much of it they have. So if oil goes from $60 a barrel to 70 to 80, the market's going to price that very efficiently. That's what they have done. But the volatility oftentimes remains bid. And so you're going to get more volatility risk premium essentially in that environment. So it can be a situation that can work in your favor.
Good stuff. Love the options angle. Love the macro talk. Mike, more to come. Thank you very much for being here, Mike Khouw. Appreciate it. Chief Strategist, YieldMax. Good stuff.
Thank you very much.
You got it. All right. When we come back, short little break here. Mr. Jon Najarian standing by for the gamble. And stocks also hanging in there. Not bad. A little change for the NASDAQ, a little change for the S&P. John's got some trades for us, what they're watching next.
There he is.
Welcome back. Here it's time for the gamble. We got Mr. Jon Najarian joining us for Market Rebellion as we look at what's going on Kalshi and more. Of course, bets on the Straits of Hormuz in Iran, all kinds of fun stuff. But I do kind of wonder, John, if maybe we just keep it simple, arguably, because as Mike and I were just talking about, I mean, it seems like a day where things have kind of reset. They're calming. That seems like a place to put on positions that might be a little bit more classic, a little bit less kind of like short-term chaotic geopolitical stuff. What do you think?
I think you're exactly right. So that's a very short hit.
Bingo. Good to see you, John.
Yeah. Well, where Oliver's exactly right, folks, is that, of course, over the weekend, and it's one of the interesting things about investment in things that trade on exchanges like the New York or the NASDAQ or whatever. There are the decentralized exchanges that trade 24/7, and there are the exchanges that only trade during specific hours, 5 days a week, unless there's a holiday. And that is why no pricing model accurately prices in those 2 days when, of course, we can't react to those markets. And what I'm talking about, of course, is the S&P 500 is where we derive the VIX, or the volatility metric, from. And obviously it does not trade until Sunday evening. So at least right now. In the very near future, that will not be the case. But right now, that is the case.
Pretty quick.
Yep. But for that reason, we get those disconnects. And so the Black-Scholes models and things like that, especially for, volatile times, don't really work. And so what do people do? Well, they come in Monday morning. Oil is 119 to the barrel, and they panic and they think, well, energy is where I want to be. No, I told so many people on Sunday and Monday, do not buy energy right now. Wait till it pulls all the way back down, because it will. And what I was looking at, Oliver, was the oil graph versus OVX. OVX is volatility of oil. And that is up 130%, the OVX, versus crude oil, which right now is, for the month, going back 30 days, basically up 35% or something like that. Now, it was up big over the weekend, yes, because of that disconnect, because there weren't traders there to jump in there and say, sold, yours, at 110, at 120. But as soon as we opened, they were both hands out, just sold, like that. So I think if somebody has a longer term outlook, longer term than Mike Khouw or me, when we're trading short dated options, by all means, these were great opportunities to sell energy, great opportunities to buy growth stocks, which Tom Lee was famous for saying this weekend to me. He said, and I retweeted it, that's why I say he's famous for it. But Tom was saying, hey, when GDP shrinks, when it goes down, you know what people around the world come for? Growth stocks. What is NBIS? What is Oracle? A growth stock.
Sure.
And both of them have intimate involvement in data centers and so forth. And
Oracle's
yet
got a monster move today. Oracle up 9%,
Yeah.
Nebius 2.
Yep. And I still think both are undervalued. So when people panic, that pricing model basically is my friend, because of course it kicks in once we start trading, and then you're looking at, just again, you and Mike Khouw just spoke about it. Volatility shoots up. If you're somebody who, with a longer term view, you probably are a seller when that happens. And I think you said that as well, Oliver. Anybody who knows options wants to hit on those times. They don't want to buy it and hold it when we have these big disconnects. I mean, Monday we were 35.30, I think, for the VIX. We barely held on to 22 yesterday. And, with Iran claiming that they're mining parts of the Straits of Hormuz, well, obviously oil popped a little bit again, a little bit. Will we ever see 120 again? We could, but again, my hands will be like this if we do. And
that's
I think
your sell
overall, yep, that's my sell. This is my buy motion, folks. All those guys behind Oliver are doing either this or that.
Yeah, hopefully you get all the fingers and not just one of them. John, the crude, that's what I like about today. And yesterday too, you got a pop in crude. Markets though are doing okay. We're hanging in there. Also, bonds are down, and one could argue that and there's inflation implications here. But on a day with CPI, with everything that's happening with crude oil, it could have been an easy reason to freak out and take risk off the table. But not only are we not, with the S&P less than 20 points down, is to go back to a few of those stocks. I mean, you had Nebius, you had Oracle. I like Oracle because it's a bigger, sizable kind of emblematic name of an entire sector that had been getting beat up. It was part of that big cloud sell-off. As Mike and I were talking about, the firming up of cloud stocks here, I think is a huge story. I think the fact that they're now showing strength in a moment of broader weakness is really important.
Yeah, clearly. And, the actual numbers that they reported were very, very strong. I mean, they weren't quite as strong as last August when the stock popped into the 300s. But look at where it's at now, folks, at 165, 166, wherever. That's less than half of where it was last August on that pop. So are these oversold? My answer unequivocally is yes, they are oversold. They were buying upside calls again today in Oracle. So there are some out there who want to run around and, basically try to panic people into selling. They are likely to be the people who are buying when people sell. And I just try to look at it without a Democrat or Republican view, and instead just look at it and say, oversold, overbought. Let's go.
I like that. So oversold, Oracle, finding support. Mentioned Nebius, NBIS, big ripper there too. By the way, the context is you've got NVIDIA GTC coming up. That stock positive today, back in the upper half of its range at 185. I mean, it's slow, it's sluggish. There's nothing big happening there on the chart, but at least it's not down. And semiconductors are also firming. So, I think there's plenty of opportunity here, John, to re-engage with names.
Yeah, absolutely. And, I think because of the Mag 7 and all the publicity and hype, in all fairness, that was brought to that sector, I think a lot of people are familiar with CoreWeave. They're familiar with Oracle, of course, and NBIS. Maybe they are. NVIDIA, they certainly are. Intel, did they forget about that? Did they forget about AMD? Did they forget about Micron? Probably. So in other words, when you've got your shopping list together, take a look at some of those, see where they were February 27th. Think back to when you thought they were either oversold or overbought at those levels, and then look at where they are now, basically 11 days into March. And I think you'll find some pretty good opportunities there.
Hey, John, one other point I want to make sure I hit you on is the crypto stuff, because finally Bitcoin is showing some life the last couple of days. It's holding above 70. We looked yesterday at Circle, which had firmed up. It's given some back today, but I know you're watching a few other plays related to that category. Like Core Z, Core Scientific, another one. Tell me what you think is the potential there for this sector to get back on its feet.
Sure. Well, I'd say we probably see, my brother Pete and I and the team over at Market Rebellion, I think we see about 20% upside in CORZ by April expiration. That's where we see a lot of, as you know, we talk about, the nice thing about options is they tell you time frame, in this case April. They tell you target, which is the strike price that they were buying aggressively, April 23rd. Now, I don't necessarily buy those way out of the monies. Instead, I buy at the monies and sell upside against it 1-to-1. That's not advice, but I do, folks. I think Cores has a real possibility to see a comeback when we have stabilization like what Oliver just spoke of. That stabilization will cause people to look again at the support system, the bricks and mortars or picks and shovels for digital assets. And one of those, of course, is CORZ. that's their bread and butter.
Yeah, like that. Especially because some of these technologies, they get kind of wrapped into broader categories as well, where, if I want to play a kind of crypto tech, I'm going to be much more interested in doing it through something like Cores than rather say a master, which is like this separate beast, this entity, this levered machine. So just because I generally remain still cynical on that doesn't mean some of these other trades, right? Bitcoin's price action is powerful. Once it starts to firm up, the miners and the ecosystem kind of starts to firm up. And that's why I took the red light off BTC too, because I generally think that, the whole risk off period we're in is going to be hopefully a buy the dip, but we'll see. Stocks green, Bitcoin yellow, maybe Cores for an options trade, buying at the money calls, selling further out of the money calls against them. Sounds like a decent way to approach it, like that spread. Thanks, John.
Thank you, Oliver. Have a great day, everybody.
You too, sir. You're the man, Jon Najarian, Market Rebellion. Nice putting on some trades, thinking about options, thinking about some risk on. But if you are concerned, I think we're not out of the woods yet. Our next Cboe exchange traded profile might be for you. We'll be right back.
increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, welcome back here to the show. We got cooking. We got 24 minutes left in the session. Stocks are trying to hold on to important levels. The S&P 500 just under 68. We've generally been thinking risk on for much of the show, but of course, the question is, what if I'm wrong? What if that green light is off and we break down instead? Today's Cboe exchange traded profile going to go into the world of TrueShares with Michael Loukas joining us, the CEO at TrueMark Investments. And you guys have a bunch of funds, but I'm thinking today about some of the very competitive options-based protection category. Mike, good to have you on the show.
Good to see you, Oliver. Thanks for having me.
Absolutely. Long time no see. Good to see you again. Tell me generally your kind of thoughts when you're talking with folks right now about the market and thinking through the lens of your products. What is most appealing? Are people feeling like this is an environment where they do need to have some kind of guardrails on?
Yeah, absolutely. I mean, I think it's not that the risk appetite has disappeared. It's the same concept we've had for realistically since 2020, where investors are looking for a way to stay invested and still manage the downside or at least reduce their drawdown risk. And there's a variety of ways to do that and a variety of ways they want us to do that. And so it all dovetails with that concept I've been talking about for years, which is, look, it's no longer about beating the S&P necessarily, but it is about performance that's good enough or performance that's tailored to particular portfolios and a defined outcome or a defined risk as well as a defined payoff. And I think investors have really gravitated towards that, as we've seen in the last couple of years.
Obviously, options playing a key role in a lot of those strategies, including a few of your guys' strategies that you recently launched. We're going to look at two approaches: defensive income and high income. Income being the key word there. Give me a thought generally, Mike, as I go to those, but firstly, just looking at where volatility is at in this context. I mean, we've been really talking about this a lot here, which is you still have this pretty well bid volatility structure in the market right now. Is that creating opportunity to get some extra juice from these strategies?
Yeah, so the two strategies that we've launched, and I think they're a pretty innovative take on auto-callable notes, and that's what these are, and that's becoming a pretty hot topic, I think, in the market these days. But we worked with Morgan Stanley and S&P for quite some time in this to put together a product where they're based on a volatility target index. And so volatility does play a pretty significant role in how we deploy these note portfolios in an effort to gain above average cash flow for investors while still giving them some level of not only intrinsic risk protection, but we actually go an extra step and add some extrinsic or an always-on hedge to the downside to protect from significant drawdowns. So the volatility does benefit us. It does help. And certainly adding some bells and whistles that give extra protection or extra volatility management, we think is an added bonus.
Let's talk about the defensive income first here, and then the high income, pay-in, auto callables, defensive income. Tell me about what you guys are trying to hit with that. Of course, it seems like for these funds, the question is always, what do you protect? What do you sacrifice to get that protection?
Yeah, I mean, we'll say this a million times, and we always do. There's no free lunch, right? So you do take on some risk. But that risk is collared. So essentially what we have here is on Pay M, for example, which is the defensive income. It targets annualized anywhere from a 10 to 12% yield. And depending on market circumstances, could be higher than that, could be lower, could be right in the target zone. But that product itself has a lower target volatility. And so what that means is the volatility doesn't have to be as high for that target to be met and for that product to hit its income goal. That income goal, again, is protected on the downside to a certain extent as the market or volatility increases, and therefore the product can reduce exposure to the market and still achieve the same level of income. You can logically infer that in times of high volatility, these products actually take risk off the table and they still hit their income goals. And I think that's the core trade-off within the auto callable sector.
Now, when you're thinking about, let's say you're an advisor and you've got a client who's been in stocks, they've been riding the bull train basically. What are you seeing in terms of how they implement these on top of what exists, or they have to sell equity to move into this? That seems like one of the main things that I encounter when I talk to advisors about how they're approaching these is how do they layer it in to what exists already?
Yeah, and there's lots of ways to do it, lots of equations we've come across, but I think the reality is you blend it in. I don't think that you sell to do this, but if your choice is to replace part of your fixed income allocation with this type of yield, then that's a viable opportunity. But again, this is equity-linked yield, equity-linked income. And so I think there's a place in your 60-40 or your 70-30, for example, to blend this in. And because it's such a significant amount of yield, it's going to give you a fairly defensive posture and certainly has a downside or intrinsic risk mitigation, downside cushion inside the portfolio. So the yield is really powerful, and which side of the asset allocation equation you blend that into is a bit of a stylistic choice. But I think it can fit in both places depending upon what the investor or the advisor is seeing as directional risk.
I would imagine the more these become popular, the more it becomes kind of a new sliver in the allocation. As to your point, it kind of serves a bond-like purpose, obviously, but still an equity-derived product. The context for yields is that they were just below 4%. Bonds kind of have that self-regulating measure where yield goes up, and then people want that yield, so then yield kind of stops going up. But down below 4%, a couple of weeks ago, I imagine that kind of makes the case for some of these products even stronger, because, if we were back at, closer to 5, maybe a bit of a different story. But anytime it seems like investors start to find appeal in the bond market for yield, it kind of goes away pretty quick all of a sudden.
Yeah, it sure does. And
5% a long time ago. And by the way, the chart lower and lower yields for the chart.
Yeah, and I think that's the reality of it, right? Even in what we consider a relatively low rate environment still on a historical basis, these are significant cash flow numbers, and these are really chunky yields. And I think that serves a purpose. The entire point of a 60-40 portfolio is that you're going to have an income component that can help in certain market environments. And this is an income component plus that's going to help you in certain market environments. So if we had a trending market or a choppy market with lots of V-shaped drawdowns and recoveries, lots of volatility, you end up with a really significant number on the income side. And that income side, when it amounts to either your total return in your portfolio, can be a significant variable. But if you're also in the cash flow business, if you're in retirement or trying to extract as much as you can out of your portfolio, that income number in different market environments still stays really healthy. And I think that's an important variable as well.
That is a good place to look at the high income. The pay H high income targets 15% yield, whereas the pay M is targeting the 10% yield, right? So we've got the pay M up, but flipping it over to the pay H, you've got a little bit of a juicier target, right? That's the main difference here, the 15% down here.
Yep. So you've got a higher volatility target. So if, say, PayH has a 35%, 35 volatility target, certainly it's going to do the same thing that PayM does. It's going to take risk off the table if volatility is high, because you don't need as much exposure to hit that volatility target. And if volatility is low, it will increase exposure. Again, the point being here is it has intrinsic risk protection built into the product. We also put a hedge on this one, underlying the portfolio to protect against meaningful drawdowns. But the target volatility in relation to the yield is pretty important in this one, because you jumped significantly in that yield target, right? You're talking about 10 and 12 on PayM, 10 to 12 on PayM. And this one's 14 to 16. Right now, it's yielding just about 19% annualized. So as you see volatility spike, you're going to achieve that yield target much more easily and with less exposure in high vol markets. Volatility comes down, you can increase the exposure, calmer markets, but you'll still chase that yield target, and you'll responsibly increase exposure to do that. So the way this toggles back and forth, again, is a true asset, into a yield portfolio or an asset allocation. And I think that with PayH, for those that are slightly more aggressive in their yield target, it's a very elegant way of producing that yield while responding to volatility up to 7 times daily with the rebalance on the underlying. So this is a very reactive product in terms of dialing up and dialing down exposure. And all of it dovetails together to produce a extremely healthy level of annual and monthly installment income.
It seems like moments that we just went through, where stocks are under pressure and yields go down, is a pretty clear kind of self-advertising for this strategy. Mike, thanks for the catch-up. Good to have you on the show. Appreciate it very much.
Yeah, good to see you, Oliver.
Pay H, pay him. Mike Loukas, CEO at TrueShares. All right, we got 13 minutes into the bell here. I think we've covered a lot of bases. We've talked protection and yield generation. We have talked speculation in the market. And right now, well, it's all gone basically flat. NASDAQ is 5 bips. But we do have a couple earnings out to think about this week. We talked about Oracle, which was very much a powerful move today on earnings. Scott Bauer's taking us into the bell in a moment. 2-minute buffer break. And then we are back here to close things out on this Wednesday as markets are hanging in there. Not bad.
With increased volatility, investors are bracing for large market moves, both up and down. Will the market rebound 30%, or will we see a 30% drop? At the end of the day, uncertainty remains a constant. Innovators' floor ETFs are designed for volatile markets. They aim to position portfolios for market moves regardless of direction or magnitude. They are intended as a core equity solution, providing exposure to U.S. equities with built-in downside protection, seeking to deliver more than 70% of the upside and targeting a max loss of 8 to 12% annually. With specified levels of sought-after protection and upside participation, we believe the floor ETFs offer an evergreen strategy designed to allow investors to remain invested regardless of the market's direction.
All right, here we go. Stocks just quiet. I think silence is a win. One of the big moves of the day was in Oracle, and we have Adobe coming out tonight, which could be a key one, as this has been bearing the brunt of much of the software-driven selling. Let's bring in Mr. Scotty Bauer joining us, Prosper Trading Academy, as we got 9 minutes left here. Scott, a lot here, I think, to dissect on an actually basically unchanged day. Semiconductor strong, cloud stocks stable. Adobe tonight, which was like the original AI destroyed stock. What's going on?
This is really good. A market like this is very good, especially after having 2% plus swings that we've become accustomed to. So tight range like this, I'm not going to say that this is now going to be the norm, because that's probably not the issue. But when the next escalation comes or de-escalation comes in the marketplace, we'll probably get a bigger move. But today, for the most part, we certainly got some info coming out of the Strait of Hormuz, but for the most part today, geopolitically, it was a quiet day. Now, take that as you will, but we see the market also quiet on a day like that. I do think that the hype behind the petroleum release from the IEA, that was really expected. And I had so many people coming to me, well, there's 400 million barrels coming online. Isn't oil going to go down? Right. Well, no, that was, kind of expected. So, I think that's why we're seeing a little bit of pressure there on the upside. And we'll just have to see what happens from here. But nonetheless, Oliver, a day like today is a good day overall for the markets. I would not expect that we're going to have many more of these in the coming days.
Okay. Now, does that mean that we won't be able to shrug off 5% crude moves more than a day or two, Scott? Or you think this is going to calm down and we'll get back to AI-driven strength in the market?
Yeah, I'm not sure we'll see 5% moves any longer or 10% moves. There could be a couple one-offs here and there, but I would bet that the market doesn't react with as much volatility as it did that we saw earlier in the week. Once we see something happen and then it happens again and it happens again, we all get desensitized to it. That's human nature. The market gets desensitized to it as well. So the more something like that happens, the less of a reaction there typically is.
Okay, that's showing up, I think, clearly today. And I think that's the most important message of it today. If we can desensitize to it, right? It's kind of like the same thing happens with bonds. Yields go up really quick, people freak out, and they get used to yields being higher. And today yields are higher. And I've been trying to make the case that I don't think we should fear that. I mean, look, here's the case in point. When bond yields were down below 4%, was that a good feeling or was that a bad feeling in the market? I think it was
actually a bad feeling.
It was a bad feeling, right? S&Ps hit their local low right after.
Yeah. Yeah, I agree. Sometimes that good is bad, bad is good. And I think in that one, bad was bad. So, why was it down there? It was down there because, things weren't looking so great. Now, the rise up of almost, 25, 26 bips, off of the lows, is that all because of oil inflation? Well, I'd say the first, 2/3 of that move probably was. And now the rest of it is more just market dynamic, market fundamentals.
Agree. Market stabilizes, bond bid lets up, the risk off trade lets up. I think that's encouraging. Now, will bulls and equities love it if we're surging through, 4 or 5 in a couple days? Probably not. But
probably not.
It's a pretty long ways away. We were at 4.3 in the 10-year. Just a couple weeks into 2026, the candles on this chart of the 10-year, by the way, for folks, and the S&P is in the purple. So 4.3%, first time we hit that, market freaked out a little bit, but then we made all-time highs right after it. So I don't mind, having a bond short in a way that's not like a negative thing.
And that just goes to show you right there also, that's another example of the market getting desensitized to a number or to a move, right? Once it happens, people have this preconceived notion, oh man, what if 10-year gets to 4.5? What if the S&Ps break 6,600? Whatever it might be. And so that initial reaction always is, I'm going to say, overstated from a volatility standpoint. And, then some of that normalcy comes back in, but that's what also makes this an amazingly robust market for volatility traders to trade in when you can pick up, when you've experienced things like this, and you can pick up on things like that is that old adage of past performance is not necessarily indicative of future performance. So if I trade on some of those volatility spikes, I think more often than not, I'm going to win, but there's going to be a time or two that I'm not going to win. But based on having that experience, I want to trade those markets and I want to be aggressive in those types of markets.
Love that point. It does feel like an aggressive type of backdrop here. Volatility is elevated, but the market's actually calm. So you've got that moment after a freak out where you can use that premium as your friend. You can use spreads, as we talked about yesterday, and you can still have a direction on without really having to worry about your face getting ripped off, as I know you like to put on the kind of defined risk trades.
The iron condors that we talked about last week. I mean, my portfolio is stacked with them.
Okay, tell me about that, Scott. Tell me about that. Give me some details. Love that.
Sure. We put one on earlier in the week in Taiwan Semi when that stock came down right to big time support right around 335. We put on a bullish iron condor. Okay. Two things. Take advantage of massive option premium, implied volatility really expensive, but we set the iron condor up so that it was bullish bias. Basically sold an at the money put spread and a way out of the money call spread. That thing's paying off nicely. We did the same thing in GLD earlier in the week. GLD got down to 467-ish, maybe even touched 466 and change. We sold an at the money put spread, sold a far out of the money call spread. So again, looking for a range, but both of those decidedly with a bullish tilt to them. And so you're able to collect a lot of premium. You're able to stay within a range, but you're also able to take direction. So that has been, I think, over the last 2 weeks.
That's the trade right now.
Yeah, we've traded more of those than anything else.
I really do think that's the trade because it's easily customizable to your directional bias, but then also plays against that backdrop of elevated volatility. For sure. It just ups your odds of not losing money and making money. To that point, Scott, I wonder, last thought here before the bell. I mean, Adobe was the first to kick the bucket. Obviously, implied vol pumped up there. You know, this is kind of my earnings of the week because if there's anything positive here, then that could be signaling the end of the AI destruction trade.
Yeah, I mean, the market really wants something positive here. Adobe has been absolutely, we don't use this term lightly, but it has been taken out to the woodshed here. So if we get an upside surprise, which I would say the Oracle report was an upside surprise. I think most people were looking for, just the overall theme in the market being bearish right now. The charts in Adobe look awful, absolutely awful from a technical standpoint. Maybe it's time to break that on the upside. I don't know, but the market would certainly take that with, a big hearty applause and really big sigh of relief.
I think anything other than down tomorrow for Adobe could easily be the sign that the SaaS apocalypse is coming to a close. So we'll watch it. Love the Iron Condor approach for more of it. Boom, scan it right there. Mr. Scott Bauer and Team Prosper Trading Academy. There's the bell. Thanks, Scotty.
Thanks, Oliver.
Great stuff. All right, that's it. Thanks for tuning in. 3 p.m. Gotta go.